People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees, they don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. My name is Randy Cook. I'm here each week with Charisse as we go through some of the things that you might be wondering about or concerned about, or you don't have a financial advisor in your life and you know, one of these days I got to figure that out. Well, that's why we have this show, is to introduce you to Charisse. How are you doing today?
Oh, I'm doing fantastic.
Good.
Feeling a little blue today.
Hey, you've got the blue on today is what you've got.
Blue it is.
But we're working our way out of summer here. We're into September now and past Labor Day. So it's school days, it's the vacations are over days, and let's get down to business.
It is straight up structure and just getting work done at this point.
Gotcha.
Because the holidays are going to be here before you know it. And then we're going to be like, where did it go?
That's a great point. I think that you and I over the years have moved our talk of end of the year planning through November, October, and now we're into September. And it makes sense because, once you hit Halloween, the year just goes zing and it's gone.
I know. What we used to plan for in November, we're definitely doing in September. Yeah. For sure. Yeah. And, we get busier here, too, in our office. And so planning for all the clients is a big deal. So you got to really re-up the game and strategize a lot sooner. Even even during the summertime, we're strategizing. Yeah. Even more so than we used to back in the day, because things are changing and evolving all the time. And having 6 months in advance notice of planning makes a big difference, actually.
Well, we're going to talk a little bit about that on the show today, because the idea that there are things that are changing outside your scope of influence, which is the political stuff. We've seen changes in Social Security that are coming up. We've seen changes in tax brackets. We've seen all sorts of different changes. And certainly we got to keep up with that stuff. So we'll be talking through some of that today. All right, so there's always a lot of, guessing when it comes to the stock market, and there's plenty of people out there doing that kind of guessing. So when we talk about how we put our portfolio together, you and I have talked ad nauseum about the 60-40 portfolio. 60% stocks, 40% bonds. It's kind of a generic starting point. It's a rule of thumb. If you say, where should I put my money, Google, how should I allot it? It'll say 60-40. Well, the people at Vanguard are looking this year and 10 years down the line, and they don't see a lot of great things for the economy, apparently, because they're suggesting that people should have a 30-70 portfolio, 30% in the market, 70% in bonds, because they believe the returns are going to be lower over the next couple of years. Do you have any clients that are 70% in the protective area?
No, number one, the math is wonky, number one.
All right.
Because if there's going to be a lower rate of return, why aren't we investing in more equities, number one?
And getting in at the low point. Yeah.
Right.
Okay.
Especially if there's momentum moving forward at a lower risk, potentially, maybe not. But to go into more bonds would be not mathematically sensical to me here.
All right.
So the reason why we've stayed away from the 60-40 portfolio is because if you have 60% of your money in bonds and you really weathered the last 5 years, your average returns are a lot lower than they would have been the 5 years prior to that, because it's based on interest rates and the fluctuation of interest rates. So your bonds can lose money when interest rates change, and then when, if they change again, they come back up. And so the average rate of return that we've seen historically from bonds is just not your grandparents' retirement.
And right now we're looking at an environment where they're doing nothing but talking about lowering the interest rate.
Yeah. And so when this type of environment takes place in our universe and financial services world, you start looking outwardly to alternatives. So you can look at notes. There's a really stagnation of notes out there, and some firms can really offer some really glorious notes. And it's a way to make money when the market goes up and it goes down. There's annuities. Annuities today are better than ever. The right kind of annuity, though, right? I mean, there's 1,000 annuities, but here at Zinnia, we're only going to offer 5. Okay. There's a reason there's only 5. We're talking about some of the stellar, top of the fold type of annuities. Sprinkling the right CDs and for the right amount of time is going to be key. And then having the right bonds, right? Maybe the muni bonds aren't the best option. And maybe it's more of the exchange traded funded bonds. You can get in and out, and a little bit of a less passive strategy in a 60-40 portfolio could be helpful, but not all your eggs in one basket. We would never say, okay, you're retired. Okay, we're going to follow 60-40 or this 70-30 and wham, bam, we're done. No, that's old school planning. So we don't want that, especially when we're trying to root for a higher rate of return, right? Because how do we get a higher rate of return, still stay safe, still keep fees down, but still be able to play in the fold of the stock market without all the losses? Because people fear running out of money, because when there's big losses in a portfolio, you still need to take your income. So you got to be a little bit different today than we were 10 and 20 years ago when it comes to investing.
It's interesting to me that when you read any article and they talk about, your mix between stocks and bonds, it's always stocks and bonds. They don't give you any alternatives other than bonds. And there are alternatives out there. When people say, Sharice, I want my money to be safe, or I want to be conservative. I've never been a risky person, so I can see myself 50-50. I can see myself 40-60, even 30-70, but having it all in bonds may not be the answer.
No, certainly. So anybody who's, I don't know how many people come in, they're like, oh, we're a private client and we have all the private client bonds. I'm like, that equals to nothing to me. Private client bond portfolio to me is like, okay, so we're averaging 1% to 3%. Maybe some things are tipping a little higher. So you're paying 1% to 1.5% in fees to be this private client. For what reason? Because you feel like bonds are the strategy when they're really not. So you got to get out of that old school thinking. I mean, you can be my private client. We'll keep you out of the bonds. I'll show you what a real private client deal looks like, right? So it's a little tricky, but being able to change with times when times come, and that right advisor that knows how to shift gears when it's time to shift gears is key. Just like COVID. We had to shift gears really quickly, Randy, if you remember that. It was a new strategy.
The economy completely stopped. I mean, what do you do?
And then 2 years into COVID, then we had to change again because the interest rates and the bonds. And 2 years later, the market's moving forward. And now we got Bitcoin. We're kind of shifting gears again. And so being able to bob and weave through these different time frames, I think, is key.
I think this really talks to, we all know, I think, that we need a financial advisor to kind of guide us into retirement and get us set. But it also says a lot toward that person who's with you, who walks with you through this whole journey. Because if you think about it, 25 years ago was the year 2000, and we had the tech wreck. Crazy. And then, in 2008, we know what happened there. We had the major crisis there. In your retirement years, 20, 25, 30 years, we're going to have some of this stuff. And we got to have somebody to walk through it with us. Give us a call at Zinnia Wealth. We do what we call a complimentary retirement consultation. What that means is exactly what it says. It's a meeting that has no charge, no obligation. We're going to look at what you got and figure out what you have done for retirement and what does it mean for you in retirement. What kind of a paycheck does it mean? Are you headed for a tax problem? Are you handled with the estate planning issues and all the different things that go with retirement? Let's get it all locked down for you. Our number is 833-368-3680. Again, 833-368-3680, or online, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that and you'll be on your way. Well, Sharice is right on the edge here of doing her 29029. She's going to climb up the mountain as many times as it would be to go to Mount Everest here. So good luck with that.
Thank you.
And we'll get the report from you when you come back.
36-hour endurance challenge. No sleep. My feet are going to hurt when I come back, and I'm supposed to eat every hour on the hour. Good luck to me.
So I'm going to talk about fitness here for a second, because all of us have heard the 10,000 steps a day thing.
Yeah.
10,000 steps a day and you can remain healthy. Well, there's a new study out, and it says, maybe not 10,000. How about 7,000?
Okay.
We'll get you about the same reaction, the same health.
You have to eat less calories?
I didn't say anything about that, just the walking. So they've adjusted the number. Okay. So you and I talk about numbers all the time. Everybody says you need this much to save for retirement. 1.4, 1.5, $1.8 million to save for retirement. I mean, I just read another one this morning that said, how much do you need to have $10,000 a month in retirement? And their number was $3 million.
Yes.
And I thought, I wonder if that's right. If somebody wanted $10,000 a month, do they need $3 million to get that?
No, they don't.
Okay.
They're probably not including Social Security.
Right.
If there's a Social Security check, and if you've saved $3 million, need $120,000 in income, you probably have a pretty steady Social Security check.
So, yeah.
Husband and wife, you could probably have at least $50,000 a year, right?
Right.
So if you need $120,000 a year and 50's coming from there, then you only need another $70,000.
Which means you don't need $3 million.
It means you don't need $3 million,
Okay.
right?
All right.
So there's this myth that you have to get to this special magical number to be able to retire. But what people aren't doing is they're not doing the math. They're not taking the inventory and really looking at the logistics. I mean, you're not contributing to a retirement account anymore, right? Most people are almost on Medicare, so insurance costs come down. Most people need 80 to 100 grand gross income in retirement nowadays. And 40 to 50,000 of that comes from
Social Security.
And if you happen to have a pension or military, that's just icing on the cake. So on $1 million portfolio, Randy, if you follow the Mythbuster 4% rule, that's 40 grand, right? So if you're trying to maintain your principal and you're going to be super ultra uber conservative and maybe only make 3 or 4% a year, and you don't mind biting into your principal a little bit, $1 million, easy peasy, and still leave a legacy, no problem.
Not that hard to lift.
It's really not. I see people who retire off $500,000 and they're just fine. They have Social Security check. They actually have some rental income. People forget to include that as part of the gig. And then they have these CDs. People always later on, we find out they have extra CDs that they're pulling income from.
Okay.
And so don't forget those little things that you guys have tucked away in the corner at the banks and all those places, even in your safe. Those are monies that are going to be pouring out for retirement. So you got to add all that in. So most people, you don't need what you think you need. And that's why it's important to do math on your retirement. So then you really know, because if you could retire today based on the math, but you actually don't retire for 5 years because you think you know the math, but you really understand it, what are you going to choose? Well, you're probably going to choose today, especially if you're sick and tired of being sick and tired of work. So.
Well, I think that one of the things that we have to know is that people don't spend as much money as what you think they do in retirement. You may say in your head, I need $100,000 a year, and you throw that out of the air, and then you find that that's way too much. I'm not going to spend that much.
Yeah.
The average couple spends $6,000 a month. Couple spends $6,000 a month in retirement, and more than half of that comes from Social Security. So just add those kind of numbers up. That's the kind of math that we need to do for you. So if you're worried and think, I don't know if I've saved enough, these numbers are so big, well, let's just do your retirement math. That's what is key here. Give us a call. We'll do it for you. 833-368-3680. It's a complimentary meeting. We'll sit down and look at what you've done to save for retirement. What does it mean for you? Are you headed for a tax problem? Do you have everything buttoned up for your retirement? And that is what comes out of that meeting. Let's sit down and talk through it. You can use our website, which is zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. All right, let's talk a little bit about 401ks, because that is the place where most of us have saved our money for retirement. A new study looked at 58,000 401ks. That's a lot. And they found that many of them are guilty of underperformance and excessive fees.
Yeah.
They bring up one here from a national airline that has $2 billion in assets, underperforming, and they charged 64 times more fees than the comparable benchmark. That doesn't sound good.
Yeah.
Now everybody's looking at themselves going, I wonder if my 401k is good or bad. So this is part of the portfolio x-ray.
It is.
What do you find out when you dive into that 401k? What are you looking for, and what comes out of that examination?
Well, it's funny because a lot of people are listening probably saying, well, my 401k doesn't have fees. I've never seen fees. Of course you don't have fees.
Aren't you cute?
Aren't you cute? And so what we find out, I mean, go back and read Tony Robbins' books. I mean, you uncover a lot of fees in retirement accounts and 401ks. And then we see underperformance. So It's important even while you're working and starting to prep for retirement. And say you're 5 years before retirement. You want to make sure your 401k is doing what it needs to be doing, because this is the last 4 years and you need to make that account work for you and count. And some of you might have been, you might be with an employer for 30 years and you don't even know, but you probably have a pretty decent retirement account. But are there things you can do inside of it that could make it even better? Because there's really nobody for you to work with when it comes to your employer. You can call somebody up and they're like, oh yeah, just do this. And there's no explanation. So part of our portfolio x-ray is going to look at the risk. If there's a roller coaster ride in the stock market and you're 5 years before retirement, it's going to say, hey, can we lose 35%, 45%, or 50%? Like, how much can you actually lose being this close to retirement or whatever age you might be? Number 2 is the fees. Like, are you being charged 0.5% of fees, 0.25%, 1%? I mean, we've seen 2 and 3%, Randy.
Oh, good grief.
2 and 3% in fees. It's ridiculous.
And you brought up Tony Robbins. Tony Robbins said 1% extra in fees can take away 10 years of retirement money.
Yes.
Good grief.
Crazy.
That's nuts.
Yeah. So if you're looking at the higher end of 2% in fees, that's just a lot of money. And 401k companies are getting a little bit better about that, but we still uncover these high fees. So the portfolio x-ray tells you your risk. It goes over your fees. It aligns, like, do you have overlap in your portfolio? Like, everything in your 401k, is it doing the same thing? And the question is, do we want everything doing the same thing? Or we want things doing different things at different time, but hopefully still making money at the same time? So we want to look at those types of things. And then performance.
Right. So that, when you bring up risk to me, that means, am I getting paid off for the amount of risk I'm taking?
Right.
So if you have money in, I can't imagine there's a hedge fund in a 401k, but if you have something in a tech fund, that could happen, and that can be high risk. It can be a little bit more high flying, and if you got a lot of money in there, but it's not paying you off, that's not a place to be.
Yeah, I mean, lots of high risk investments doesn't mean high reward.
Okay,
right?
Not always. Yeah.
Yeah, I mean, you can have a most fantastic hedge fund manager built into your mutual fund strategy, yet they're failing. When you look at something called the Dow Bar study, they weigh and measure every fund out there, and 70% of the time they fail to even beat the benchmark. So our philosophy is, if we're having to really sugarcoat and figure out what are the best managers and how do you do it, why aren't we just investing in the things we're trying to beat? So why aren't we just investing in the simple things like the large cap, the indexes, the S&P 500, and making sure we squash all those amazing strategies and just do what works. So sometimes we make it so complicated, Randy, and it's really more simple.
Sometimes it's just moving some things around.
Yes.
And you've mentioned in the past that we've been so dependent on mutual funds for such a long period of time, but now moving over to ETFs can actually give you fewer fees and maybe the same performance with the same kind of holdings, and it'll just be to your benefit to just move some things around.
1,000%. But the only problem is in 401ks, you don't really get ETFs.
Oh,
you get the amazing target date funds, which we're not fans of. And then the second thing we're not fans are mutual funds. So there's a small menu in a 401k. So the world is not your oyster in a 401k, but that is more of a reason to, if you are 59 and a half and older, and you are in a 401k, 9 out of 10 times your employer will allow you to move it over to an IRA, work with a local advisory firm that you like, and now you don't have 30 options, you have 30,000 options, and now you're really trying to create a plan, and you have those exchange traded funds and extra things that you did not have in your 401k.
So the idea of rollover then is you don't have to roll all your money out of a 401k, but even if you did, you can still participate in it and get that match that is so important.
Yeah, so that's key. A lot of people are like, oh, I don't want to move my 401k because I'm contributing, the employer is putting the match in. Hey, this is the really cool part about this is that if your employer says, hey, you can move 50% of your money over to an IRA, no taxes, no penalties. Some of them even say, even 100%, they will still let you contribute to your retirement account. They will continue to let you have that match. You're just taking control of your money now and starting to create that plan that works best for you with all the other options, but not on new money, of course not.
Yeah, I think that some of those names sometimes in the 401k can be deceiving. You know, the Wellington Admiral Make Me $1 Million Fund. You know, that sounds good.
I do like that
one. and you just don't know until you really dive in there. And if you try to dive in there, I mean, what are you looking for? I mean, that's something that you can do and say, okay, we're going to go into this fund here, see how it's doing, what is it costing you, and how can we do better?
Well, and on top of that, sometimes, like if you're that 1 in a million person that comes in and you're over 59 and a half, you're like, my employer won't allow me to move this money.
Okay.
Well, at least give you some hindsight on, okay, so these are your options. Based on what your goals are and your projections, maybe we need to exit these and pour more energy into these types of funds. And we'll at least give you that direction. What if you came in and you had 50% of your money all in like the Russell, right?
Okay.
I'd be like, no, that's not the direction, right? Not right now, maybe a different time period. And just really re-cater how your asset allocation is sitting inside the 401k so you can be ready.
This is where most of our money is. Cherise tells me that all the time. Is it used to be, as your parents would come in, their biggest asset was their home. Now, our biggest asset is that 401k. And it's not unusual to have $500,000, $1 million, even more in a 401k if you've stayed with your employer for a lot of years. That is the bulk of your retirement money. And it's all tax deferred, which means when you start taking that money, you got to pay the toll to get it. So that's another part of the conversation with the 401k. Then we get into the idea of a conversion, moving money from a 401k over to your own IRA and paying the taxes along the way.
Now, that's the fun part.
I should have said Roth. Actually, if you move it from a 401k to an IRA, there's no tax consequences there. But to a Roth, then you do have to pay the taxes.
Yeah. So when you're rolling your IRA, so now you moved your 401k to this amazing advisor locally, and now they're managing your money in this IRA, and now they should be talking to you about some tax strategies and, hey, let's roll some of this over to a Roth, and how much should we roll over? You can do that. So even if you are not 59 and a half, so the 59 and a half rule just says, hey, you have a penalty if you take any money out of your retirement accounts before the age of 59 and a half. So that's where that age range hits, and any age thereafter, there is no penalty to do so. But if you are rolling an IRA to a Roth, well, there is no penalty to do that. Okay. So there are some rules that say, okay, even though you're not 59 and a half, you can be any age. You could be 40 years old and you just left your employer and now you have a new job, and you could take that old 401k, put it into an IRA locally, and then from there you just roll it over to a Roth. There is zero penalty to do that, right? It's
important to know. Yeah. We would love to have the opportunity to talk to you about your 401k. It is where most of us have most of our money, and it's going to be the bulk of our retirement in many cases, along with Social Security. So let's have a strategy for it, and let's make that 401k kick off some income for you in your retirement years. So vitally important. Give us a call. Give us a look on our website. Let's do a complimentary portfolio x-ray for you. Find out what's going on in that 401k. If there's fees in there that you don't know about, let's discuss that. Let's see if we can cut those fees down, limit those fees for you in retirement. If the performance isn't right, let's see what we can do about that as well. That's what it is to have an analysis. Give us a call. Give us a look on our website, which is ZinniaWealth.com, ZINNIA Wealth.com. There's a gold box there. It says Complimentary Retirement Consultation. Click on that. You'll be on your way. Or just bypass all that and just give us a call. It's 833-368-3680. 833-368-3680. All right, a lot of things in the news these days about the economy and about the numbers that we're looking at. As a matter of fact, President Trump just fired the person who was in charge of the Bureau of Labor Statistics because he didn't like what was coming out there. And there's lots of calls for the Federal Reserve to revamp the way they do things. And President Trump doesn't like Jerome Powell and he might fire him. And I mean, oh my gosh, there's just so much going on. But you know what? If we don't have reliable numbers, how are we going to figure out what the cost of living is and what the raise will be with Social Security? Mm-hmm. How are we going to figure out what inflation is? How are we going to figure out what annuities will be if you don't have a good interest rate? There's Treasury inflation protected securities. They're called TIPS, and people use those. Those are all dependent on inflation and numbers that come out. And this, Cherise, brings me to a point that I think we need to pay attention to is, what if they change the rules on us? What if they change the numbers on us midway through our retirement? It's called political risk.
Yes.
It's when they change the tax tables. It's when they change what the IRS is doing. It's what they make a change on inherited IRAs and things like that. These things are happening all the time.
All the time. You know, there's so many risks out there. I mean, you name it, inflation risk, interest rate risk, market risk, all those risks. But then the one that drives me the most crazy, it's the one that is not predictable, that can change very quickly, is geopolitical risk. Mm-hmm. one new president, one new this, one new that, one change here, and everything that we have known to be known for all of a sudden changes, right? I mean, think about the Roth IRA. Like, the goal of a Roth IRA is to have tax-free income in the future. But if we're not taxed on our income in the future, then what was the point of the Roth IRA and all this work? But then if taxes are on the rise, it was the best thing we've ever put together. Because taxes have to go up to help pay off debt, depending on what happens with the tariffs, right? And until I see a well-done Excel sheet on the next 10 to 30 years on those tariffs, I got to see it to believe it, right? So seeing things to believing it is really important. So all these risks out there you have no control of. But the one thing you do have control of is your personal economy, the four walls and that roof of your house, right? So if we have zero risk and zero control, the best thing that we can do as we're prepping for retirement and in retirement is make sure that it's well-oiled, it's sound, it's keeping up with inflation, and we don't care about the geopolitical risk that comes with it, right? There might be some changes in the interim, but it's not going to be so detrimental for the 30 years in retirement that it's that big of a deal.
And I think that this is one of the main reasons you have to have a financial advisor in your life, because we get ready for retirement and I say, okay, I need a plan. I need a strategy. I need something down on paper. So you go see Charisse and we do that. And it's not like you then just set sail off into the sunset. We're going to sit down and revisit that plan every year, maybe twice, if you feel a reason. And people's lives change too. I mean, there's stuff going on with political, but there's also stuff going on in our own life. A spouse can pass. There could be a bad medical diagnosis, and all of a sudden somebody's in a wheelchair, and now we got to refit the house. And there's things that change, and you have to help them change along the way.
You know what I didn't realize when I got into this business and this industry is how much a life can change in such a short amount of time. And it's just not a life. It is the lives that are part of this life, right? And I've learned by trial and error and watching clients lose incomes, lose a Social Security check, lose pensions, and me not have an idea of like how to solve that problem for the surviving spouse. That was me early on as a financial planner. And as I saw these clients being derailed by all these myths that weren't myths at that time, we just realized we had to come up with a plan. So when we work our plans, we say, okay, husband and wife, you're both living, we're going to live together forever. But now I've got to show you that's in a perfect world. What happens if one of you pass away? Then we got to show you in a non-perfect world. What if you pass away in 5 years and we have a surviving spouse left over? We lose a Social Security check, we lose a pension. Is there enough money in that portfolio based on how we manage so it doesn't derail how you live your life? And so without that plan, I don't know how anybody walks into retirement, Randy, confident. Like, I really don't. Like, I get it back in the day. I'm like, yeah, this is good. We're going to, average you 6 to 7% over the next 10 years, and it's going to be great. But then, okay, what about when we need dentures? What about when we need another car? Where's that money come from? What do we do when somebody passes? What do we do when a kid needs $50,000 for a down payment? I have seen it all. Expect the unexpected. And then one of the biggest things that I think hurts me the most is watching the client, their health get derailed so early. And then we need money earlier for that, right? Or long-term care earlier for that. And then we leave a spouse financially destitute because the plan wasn't in place. What happens when this happens? So you got to have that what-if plan. And so, again, we were talking about geopolitical risk. It's another risk. I mean, there's so many risks out there. So let's just figure out how to, de-risk your
the risk
in retirement, because it's a whole different risk. I call it the retirement risk, because there's a bunch of bottles that are filled up with risk and problems. And how do we pop through each one of them, saying, okay, we got that if that happens, we got this if that happens, we got that if that happens. Give me something else. Give me something new. Test me, right? Because we're always bobbing and weaving, and every year, sometimes you were right. Sometimes twice a year, we're having to rejigger an income plan, which is always so shocking to me. I never knew I'd be changing income plans so often.
Interesting.
And the best part about when I'm changing income plans is when we're a year into retirement or something, 2 years, and my clients are like, Charisse, I've been listening to you long enough. I think you're right. I am ready to spend money. And that's when I'm just like, yes, check one more down.
I like
the Zinnia happy trail.
Well, we just recently did an interview with Jonathan Fleece from Empath Health.
Yes.
And I invite you to go to our podcast and revisit that if you haven't seen that yet. And Jonathan is a guy who helps people as they're either dealing with a parent going into long-term care or themselves, and they feel like that's coming, or they get a diagnosis like that, and that in-between time to try to figure that all out. Health situations and a health risk with these are really vitally important, because you get one of those diagnoses for your spouse, and then you go, oh my gosh, $10,000 a month for long-term care or memory care or something like that. And then you worry about somebody being left destitute, because if you go to Medicaid, you spend your money all the way down to about $2,000, from the nursing home. And then the other spouse is out there going, what is going to happen to me?
Yeah. And a lot of people always come in, Randy, and they're like, well, what about this long-term phase of life where, what if I need nursing homes, or should I be buying long-term care insurance? Should I be buying life insurance to cover, and that is part of the plan. When you guys come in, we're going to talk about that. I'm going to say probably 7 out of 10 of you who come in will say you probably don't need to purchase one of those policies because you could self-fund, but let us do the math for you. Let me show you if you can self-fund. And if you cannot self-fund, we will start backtracking, go backwards, say, okay, here are your options. You pay for what you get. So if you want this is how much it costs. If you want this is how much it costs, and this is how much it's going to cover. And then you get to choose. And if you don't want to cover your long-term care, the future of that, then I get it. Nobody wants to pay a premium for something they might not use. They say the average stay in a nursing home is 1 to 3 years. It seems like now it's like, 3 months, 6 months? But I think we're running off COVID stats now, so it's really even hard to tell where we land there. But you do need to have a plan in place. What if somebody's in a nursing home for 2 to 3 years, and then see it on paper, because at least you'll feel a little bit better walking into retirement about that.
So many different risks that we need to talk through when it comes to retirement planning. Charisse mentioned inflation risk, market risk, longevity, political, healthcare. There's a lot of things to talk about, and we would love to have that conversation with you. Give us a call. Give us a look on our website. It is ZinniaWealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. That's exactly what it is. It's a sit down with you, no cost, no obligation. Let's figure out what you've done for retirement, what it's going to do for you in retirement, and are there ways that we can help. 833-368-3680 is our number, 833-368-3680, or again online at ZinniaWealth.com. All right, I mentioned this. There was a study of financial advisors out there, and the question was this: are you changing your financial strategies for today's economy? 65% of them said yes. What's wrong with the other 35? But 65% said yes. So then the next question is, how? What are you doing differently today that you weren't doing before? The answer was, we're starting to use annuities. So here we go again.
Yeah.
So what is it about an annuity today that is different from an annuity 10 years ago that they didn't want to use them then, that they do want to use them now?
Nearly 20 years ago, when somebody told me the word annuity, I about wanted to vomit. Honestly. Like, I was like, annuity? What's an annuity?
Right.
And then I learned about annuities. I'm like, no, who wants an annuity? Like, I was that person, believe it or not, until I read this fantastic book on annuities. And so, but annuities have changed over time. We've been in this business for nearly 20 years. And annuities, in my opinion, have changed at least 3 times.
Interesting. For
the better, which is interesting. So I'm so glad I got to see the beginning of this. But when you think of annuities, you think of income streams, right? You go back to Roman times, the soldiers, what did they get? They got an annuity. When they were done fighting and they were enjoying time with their family, they were getting an income check.
Which is their pension. Which was an annuity, right.
That's where it all stems from. Fast forward, so we created these knockoff annuities in early 70s and 80s, and you gave a chunk of money and you got an income for the rest of your life, but there was really no principal left over, but you're getting that income for the rest of your life. You might even have a pension with your employer. Your pension with your employer is an annuity. It's just an income annuity.
Social Security is like an annuity.
Social Security is not like, it is an annuity, right? So it's an income stream for life. So, go to now the 90s, they had variable annuities, and variable annuities are doing really good back then because it's all about high flyer stock market stuff, right? And so that was the variable annuity, but they were loaded with like 4 and 5% of fees, which was ridiculous. So people were buying the annuity for the wrong reason back then. So they got a bad name for themselves. And now we just don't touch variable annuities because they're registered under fee. And then the annuity before that, we don't really offer because you're forfeiting your lump sum to get some income when we can get you income somewhere else in a different strategy. And then 2007, 8, and 9 rolled around. And what do we have? We had our fixed index annuity, equity index annuities, hybrid annuities that had caps of like 5 and 6, maybe 7%. That was a max you could ever make on them. And that was a really short run of that. And then fast forward, now we have these growth annuities. And it's just a little different than what we've seen the last 3 rounds of annuities. It's because you can invest in the S&P 500, which you have been able to do before, but now you potentially can make more money because you're running side by side with the S&P 500. And so some companies say, hey, we're going to give you 50% over the next 12 months of whatever the S&P 500 does. So if the S&P 500 does 20, you get 10. If I go back to some of the old school annuities, the most you could make was a 5% return. So if the S&P did 20, you only made 5, you're thinking, what kind of junk is this, Sharice? I'm like, oh, you said you wanted safe and no fees. 5% is pretty good. But no, but they wanted that 10. So fast forward, they just keep evolving because that's what the average individual wants. And these insurance companies and companies across the country, they're actually seeking to satisfy the human being for the first time because they want you part of their portfolio.
Well, look at all the baby boomers that are retiring now. They have had to say, okay, what's the market out there? What does the market want?
Yes.
65 million people retiring. This is what we want. So they came up with it. I always use my example of there was an iPhone 1, there's an iPhone 16. Which one's better? The 16 because it's evolved along the way because we wanted a better camera. We wanted more apps. We wanted a calculator. We wanted all these different things in our phone, and we got them. And that's kind of the situation you're in.
Exactly. It's just timing. It's interest rates. It's after COVID. It's just where everything's landing. So it just happens to be right now. Annuities are the cat's meow, and we're seeing people make some money from them more than we've ever seen historically. And it's just not about an income play. It's actually a safety play. It's a growth play. It is a bond replacement play. Why would I have a bond in my portfolio when I can have an annuity that could potentially make 10, 20, 30, 40, 50, 60%? Like, why? And there is no why. It's just you wouldn't have the bond, right?
And then the downside is that the annuity, once the market goes zero or goes negative, you don't participate in
You
that.
have a zero, right? And in the interest rate world and bonds, if interest rates shift, your bond could go negative, which we've seen many of times. So now you got to wait for that bond to get back to even, and then to hit an all-time new high, you got to make at least 4% again. Where in the annuity, there's no interest rate fluctuation when it comes to if the bonds change in interest rates and markets aren't doing what they want to do, you just get a zero. So you don't have to play catch up to get back to even. And it's just the simplicity of it. So some people come in and are like, Sharice, I wanted nothing to do with annuities. I'm like, that's fine, but I'm still going to coach up on them because if we're offering them as an option, if it's an option to replace the bond portfolio that has a fee, why wouldn't we consider it? Especially if we truly believe that's the way of the future.
Well, in any situation, you're going to make any kind of a purchase, whether it's you're going to buy a car, you're going to buy a computer, whatever you're going to buy, you kind of look at that salesperson and you go, show me everything you got. I want to see all of what you have.
It's not your iPhone 1.
No, that's right. So you kind of got to look at Sharice and say, show me what you got. Show me all the opportunities that I have to put my money someplace that'll give me income, it'll give me growth, it'll give me some safety. We want to see everything. And I think that that's important you make your own decision, of course. But to find out that there's something out there that your financial advisor wasn't showing you, that's a red flag for me. And I think that you should see everything that's out there. Give us a call. Give us a look on our website. Let's have a discussion about what's right for you and what's out there, and you make your own decision. ZinniaWealth.com, ZINNIA Wealth.com, or give us a call. Let's talk about you and your retirement. Actually put something down on paper. Give you something to follow here. 833-368-3680. All right, it happens to me all the time. I have conversations with friends and coworkers, and they go, are you watching this? Are you watching Severance? Are you watching this show? And I go, oh, no, I'll try it. So I get home, and me and Julie sit down in front of the TV, and we click it on, and we go, I don't get it. I don't understand. This is not for me.
Not for me.
Not for me.
Yes.
Well, that happened to us when everybody was talking about Hamilton. And Hamilton has just celebrated their 10th anniversary. and they've made over $1 billion
Wow.
in New York on all of this stuff. Well, I kind of watched Hamilton and feel in the same way. This is a comedian, and his name is Sebastian Maniscalco. And he and his wife sat down and watched Hamilton, and this was their reaction.
So this thing starts. 10 minutes into Hamilton, I tap my wife. I go, I got no idea what's going on. I couldn't understand it. I didn't even know what Hamilton did. I went to this play to find out why this guy was so fabulous. And you gotta understand something about my wife and I. We are dumb. I'll tap my wife. I go, you know what's going on? She's like, no, you? Nothing. Like, no. Like, we just sit there. Dumb.
Dumb.
It's so funny.
It's like looking at modern art. It just makes you feel dumb. Okay. All right. So the way I want to talk about this is there are financial advisors out there, and I hear this all the time. Smart guy. Didn't understand a word he said.
Yeah.
That people will go along with financial advice just because everybody else is doing it, and everybody else says it's a good thing.
Sometimes you just smell really good, look really good, sound really good, but are you really good?
Uh-huh.
But if you're selling somebody and they're nodding their head, you must be good enough.
Yeah. And I think people will look at their financial advisor and just go along with stuff sometimes. And if you
Out of fear of feeling dumb.
Yeah. And if you don't understand where your money is, I don't think that's good.
No, and I will probably say, I mean, literally, Randy, I've heard it over and over again. 8 out of 10 people nod their heads. They don't understand what the advisor's saying. And they're just like, okay, we're going to trust you. And they hand it all over. And then they're in this fog like, okay, let's hope this works out, honey. And that is awful. Can you imagine? I can personally imagine myself retiring and just saying, hey, Randy, you look really good. You sound good. But then not to really see how good you are or what you've done in the past or what can you do for us in the future. And you're just going to show me a bunch of pie charts and say, hey, yeah, this looks great. We're going to average you 7% over the next 10 years. Don't worry about it. Like, that is not confidence, in my opinion, in retirement. And I'm okay with that when you're in this accumulation phase of life and you're growing your money. But when you're in this decumulation phase of life and now we're living on your money, I'm sorry, this is a whole different puzzle. And the right advisor for the right season of life is going to be the most important decision and thing that you decide, in my opinion, as you're nearing or in retirement. Because you don't want to screw around and get this wrong because the domino effect can really crush you. And one of the biggest mistakes is just having a huge loss in your portfolio. If you need if you need 40, 50 grand a year in retirement and you just happen to go with the stock jocks, they look good, sounded good, smelled good, and you're like, oh, hope this works, and just stick your head in the sand and not really do anything to ignite your own retirement and get involved, then yeah, Houston, there's going to be a problem and it's on you. It's your fault.
I think that the market sometimes makes financial advisors look good. If the market is up, then you think that person's doing a great job.
Yeah.
But you should really look at the services that you're getting. The market is making that person look good. Are you getting tax advice? Are you getting estate advice? Are you getting all the different things that you provide?
Yeah.
And it's got to be more than just, hey, stick your money in the market. The market will do the work.
Well, that's a good point. Like, people are like, well, what do we care if Cherise offers estate planning and Medicare planning and Social Security planning? Like, what do we care? We just want our money to grow. Like, it's a full package in retirement. When you're ladies, when you're finding your very first husband and only husband, and you want the full package, tall, dark, handsome, or whatever it might be.
It was a small slip there, but keep going, please.
Just gonna keep going. It's a package deal because your estate plan, if you don't get your estate plan, that might not hurt you right now, but it's going to hurt somebody's pocketbook later because it's a bread and butter for these attorneys if you don't have a estate plan ready to go. Anything that goes through probate, 5 to 10% of that say goodbye to the attorneys. I mean, 5 to 10% of your estate, goodbye. Like, does that sound like a good plan? No. So all those little moving parts matter. Social Security, you don't claim Social Security in the right manner at the right time, you could also screw yourself. Excuse my language. I just did an income plan for somebody, and the plan was to take the Mrs. Social Security at 65 and Mr.'s at 67. We went back to work right before he retired and said, let's just see, what if we took it earlier? Do you know that based on our conservative rate of return, there was more money 30 years later by taking it earlier because it took the pressure off the retirement accounts. All the while, we're still able to roll IRAs to Roth and create a cool tax plan. I was actually surprised myself, and this is why we always double check and test things. So that's just for that moving part. But then let's think about the tax plan. You have an advisor that's not just managing your money and your Social Security, claiming it at the right time, and in your estate plan and making sure that the attorney doesn't get you in the rear when you're not even here anymore. But then the tax plan, hundreds of thousands of dollars you will save for yourself, your surviving spouse, and your family. Like, who's going to inherit your money? Hundreds of thousands to millions of dollars. You guys hear me out there? It is ridiculous. So, yeah, it's not just about the investment and how we can save in fees and how much risk and return. All those things count, but it's every dollar counts. And there are a lot of legs to retirement, and you want to get it right. And don't get me on long-term care or Medicare. That's a whole another conversation of costs that you better have a bucket of money ready for.
You're listening to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Online, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. If you're looking for a meeting to sit down and talk about your retirement, actually go over what you've done. Let's look at your 401k, let's savings accounts, and then there's CDs and IRAs and property and all the things that are going to power your retirement. Maybe it's a business that's going to power your retirement. Let's look at the value on that. Let's look at how to get out of that, how to sell it, all those different things that are real retirement issues that we really got to tackle. 833-368-3680. Again, 833-368-3680, or online again, zinniawealth.com. Sharice, that is all the time we have on today's show. I'm going to give you the last word on this one.
Well, time flies when you're handing out lots of free information, doesn't it? And again, thanks for tuning in. There's so many other things you could be doing today, but this is the future, and we're hoping to make your journey through retirement a little bit better of a future by tuning in. So live by design and not by default, and we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Sharice Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.